Good morning and welcome to Tuesday morning's market wrap. I'm Greg McKenna, and there's plenty to talk about today because oil closed at the lowest level in 2 months, down below $44 at 43.98. My Reuters terminal saying this morning. That is really interesting because what we saw last night on stock markets is that the impetus that we got from the ECB promise and then the Chinese action, which propelled markets higher on Thursday night and then again on Friday night, really went nowhere in Asia yesterday and then again nowhere in Europe and the US last night. Sure, Shanghai up 0.5%, the Nikkei up 0.6%. We're at 2 months highs, but the ASX couldn't follow through. It finished flat, and then futures last night finished flat again. In Europe, markets were down except for Germany, and Germany had the IFO business climate out. It was better than expected, but still lower than last month. So, some, slash positive news, if I could put it that way, but not really. I hate people that do inverted commas. I never do that. Don't know why I did that anyway. And what you saw for the rest of Europe was a lot of that caution coming out. And the reason that people are being cautious, the reason why traders can't embrace their inner bull, is because the next leg and the impetus for the next leg, they're a little bit worried about. What we've done now is most markets have corrected back, rallied around 10% or more from the lows that we saw back in August. We had that period of consolidation in September. We've had the good rallies. And the charts suggest, particularly on a weekly basis from the S&P 500, as I discussed yesterday, the charts suggest that there could be a little bit more in it. But traders for the moment are not convinced. Some would argue that this wall of worry the market has to climb is a bullish thing. What I'd say is it just continues the theme that traders are still uncertain. Last night we had some data on housing in the United States, which was weaker than expected. And we also had other economic data that kind of starts to show that maybe the sweet spot for the US economy is behind it. Likewise for stocks, you've got a US dollar, in dollar index terms, which is up at 97, down at 110.5 in the euro, 153 the pound, 121 yen. It's getting stronger again. And traders know that the domestic part of the US economy, the internal bit, is looking okay. It's looking strong, I would say. You've got unemployment, close to full employment. You've got total employment, going strongly. You're starting to see wages inflation start to increase. Consumers doing their bit. There's an interesting article. I've linked it in my 20 seconds for traders piece on Business Insider this morning, which I'd suggest you have a look at. It was written by Elena Holodny. I assume that's how you say her surname. Apologies if it's not. From BIUS. And what it looks at as the performance of those consumer discretionary stocks, the ones where people only spend their money when they've got it, so US consumers, and how they're doing relative to the rest of the earnings season reports. What that shows us some really solid growth. What that tells me, once again, is that interest rates in the US at 0 are completely incompatible with where the US economy is. Sure, oil continues to fall. All we need oil to do is stop falling for 3 or 6 months, and those inflation numbers affected by oil drop out, and suddenly you've got an inflation problem. Suddenly the Fed's scrambling. So it'll be very interesting. And I think one of the reasons why the market waited last night rather than rallied on was because the Fed meets tonight for a 2-day meeting. If we have a quick look at the S&P 500, and then I'll get back to oil, what we've got for the moment is we've got this 200-day moving average, I hope, and we closed above it on Friday. And even though we had a down day, a small down day, 0.2, it could have been worse. And the S&P 500 is looking still reasonably positive. There is a massive support zone, which is all the way down here to 2030, which is my fast moving average. Now that's going to come up pretty quick over the next couple of days. But let's say you look at 2038, which is the old trend line that we've broken back into. Pardon me, 2045, which is the previous bottom of the range, that zone is going to be support. It would really have to cascade back down and through there to get overly bearish. I must say though, when I look at this chart, and I use my normal trading style. In many ways, I'm a bit like Livermore. I like to trade as close as I can to the point of pain, if that makes any sense. So it's not necessarily a contrarian trading system, but it certainly takes advantage of markets when they push too far too fast. And what I'd argue when I look at my charts is that, yeah, it could rally a bit, but we're close to a short-term top. Certainly on the 4 hours, we could see it back down into the 50s or something like that. But I don't trade S&P on 4 hour charts because I try and sleep when that market's open. But if you think about that, have a look at that chart and think about that chart, and then have a look at this next chart, oil, USO. Now, oil closed right on a really important level. The 43.98 is actually 25 pips higher than where it was when I updated my Go Markets report literally just 10 minutes ago. No, they fixed it. It's 43.78, which is where it should have been. Good. So what we've got is we've got oil right here on this trend line. Now, why is that important? It's really important because it's completely the opposite direction to the stocks. Now, what does that tell you? That tells you stocks have been boosted by promise of QE, China's rate cut, but traders in other markets do not believe that those measures are going to work. Traders in the oil market, traders in the iron ore market, which has dropped 10% in the last 2 weeks. Have a look at David Scutt's article at Business Insider. Traders in those markets do not believe that that is going to fix demand. They believe central banks are behind the curve. If you get oil in MT4 terms, crude, closing down through or pushing down through, say, 43.65, 66, then you can easily see it run down to 40. And potentially, given this massive rejection up here of the 200-day moving average, you could see it head down under 40 bucks. We'll have to wait and see on that one. That's the weekly chart, but the outlook has certainly changed. Now, if we have a look at what's the impact of that on the ASX 200, a bit of an inside down day, yearly positive. Don't forget, this is MT4, so this is cash plus futures. And what we've got here is we've got a down day. That suggests we might get some further weakness. Likewise, if you think about it, if oil's crashing and it fell 2% last night, if iron ore's down 10% in 2 weeks, then the banks are going to have to do a lot of heavy lifting to drag the index back into the black. So keep an eye on that. One last chart today, Aussie US dollar. It's really going nowhere at the moment. 72, 72.80, 71.80 is the range. I'll be trading the break of that when and if it happens. So that's the setup, I guess. Bonds didn't really do too much last night. Stocks are lower. Stocks in Asia look like they might be lower today. The US dollar is backing off. Janet Yellen said in September one of the reasons the Fed did not raise rates was because of US dollar strength. And, obviously we've got a much stronger US dollar, stronger against the pound, against the euro, and in dollar index terms back as high as it was back in August. So there's a lot of competing forces at the moment. We could get a dovish Fed statement on Thursday morning at 5 a.m. That would be the catalyst for the next leg higher in stocks. But for the moment, I think stocks are looking a little bit stretched. As I didn't say yesterday, but I tweeted, I should have said, the euro was outside the bottom of my Bollinger Band, which is always a signal for a rally, which is obviously what we've seen, 50 or 60 points. On the day, it looks, I'm just looking at my charts, that's why I'm not looking at you. We could get to 110.90, maybe back even to 111.10, 111.30. We'll have to wait and see. But you can see there's lots of moving parts at the moment. It's not everything correlates to one as we've seen. So good luck. It's another good day. Not a lot of data out. We've got the ANZ consumer sentiment survey in Australia. Kiwi trade's already been out, and the Kiwi's under a little bit of pressure. It's coming back. It's flat now. It was down about 0.25% at one stage. Tonight we've got UK GDP, which is massive for sterling traders and for expectations about what the Bank of England's going to do. And of course we've got US durable goods, which will also be an important lead, I guess, into what's going on in the US economy at the moment. So have a great day. I'm Greg McKenna. You can find me at Twitter at Gregory McKenna. Always you can find me at Business Insider and my own website, gregmckenna.com.au. And don't forget, I've got that trading book, ebook I've put together on the life and times and teachings of Jesse Livermore. He was a great trader. A lot of the way that I trade is based on what he did. I discovered when I was putting that ebook together. So have a great day and bye for now.